So the FASB, as I said, is the longest standing private standard setter that has existed. There were a couple of others. They go into them in your textbook, but I don't really feel like it's worth talking about. They have a copious amount of items that they've created over the decades from 1973 to the present day. They used to have all these sort of hanging out in their own space. The concepts were distinct from standards, which were distinct from interpretations. However, because things were becoming a little patchwork, they decided to codify the system, and now we refer to these items as Accounting Standards Code. It's a deviation from prior items. You might still hear some of the older folks in practice talk about SFAS. SFAS is just Statements of Financial Accounting Standards. But again, that got swept into the ASC, which is how you will begin to understand and deal with these as you get out in practice and later on in your studies when you actually read the standards in their raw form. As I said before, it's a private body. This was not created by the government. It was created at the request of the SEC that a private body take over the standard setting agenda of financial accounting. The FASB has instituted a system of due process to set standards. It's an open system, open full disclosure of what's happening with standards as they come in. No company is taken unawares by what is occurring. There's no behind the curtains action. Hence, the process is subject to some political and corporate pressure when standards are being set. The FASB actually issues drafts of these standards, and they're called exposure drafts. They issued an EDs or exposure drafts, and they put them out to the public. They solicit feedback. Companies can write an opinion on the current exposure draft, how the standard is forming. Academics can write in and tell them what they think about the current item. Audit firms will often write in and say, hey, this is a good idea, or these parts are a good idea, but this piece is just crap. You got to get rid of it. It's no good, right? So the FASB is very open with its deliberation process. This is not a sort of monarchy where legislation is just set down without any feedback from the public. There's some other important bodies, although the SEC and the FASB are the two primary bodies in the financial accounting world. One is called the Emerging Issues Task Force, or EITF. Yes, there's a lot of alphabet going on, a lot of acronyms. Get it, love it, take it forward, because this is how it's going to be termed when you're out there in the workforce. So the EITF was created in 1984, and basically I think of them, if we're considering the accounting standards put out by the SEC as a sort of a dam to hold back the floodwaters of reporting, to try to give us some structure. If there's any cracks as the FASB builds this dam, that's where the EITF comes in. They don't issue new standards. They don't build on the dam, but they might plug up holes or seal up cracks, basically clarification updates to standards for very small issues that can be identified within existing structure that is laid out by the FASB. It avoids that whole due process time delay. Like, oh my gosh, we can't meet and issue a new exposure draft every time there's a small issue with a standard put out by the FASB. So this is our way of skirting that issue. The AICPA is also a very relevant industry within financial accounting and accounting in general. This is the American Institute of Certified Public Accountants. They used to have a somewhat larger role in standard setting. Now they are simply, they regulate licensure requirements for CPAs, including the creation and administration of the CPA exam. This is a large duty that they have to discharge. They have to determine who is worthy of being called a CPA and who is not. There's currently a large-scale overhaul of the CPA exam that's anticipated to take effect in 2024, which means that for any of you currently taking the class in 2021, that is going to be something you have to be ready for. And you can get more information on that here if you click on that link. The AICPA also provides additional practical guidance and interpretations for applying accounting standards to practicing accountants. So they don't, again, they don't even have a role that the EITF is. They can't even issue updates or clarifications. They will simply take a standard or an update and then apply it to a hypothetical situation. It's almost like you're getting taught after you've already graduated from school, and the AICPA creates a hypothetical transaction and says, all right, well, let's see how we would apply this guidance to that. The Pcaob is the Public Company Accounting Oversight Board. It was created by the Sarbanes-Oxley Act of 2002, the same act that forced CEOs and CFOs to sign off reports. And basically what the Pcaob does is it audits audit firms. So audit firms are engaged by companies to audit financial statement. Audit firms say, hey, this company is doing things we believe in line with US GAAP, right? Audit firms issue an opinion about how the annual report complies with GAAP. Now, who decides whether or not the auditors are doing a good job? Well, that's the issue of the Pcaob. Sarbanes-Oxley essentially looked at, what happened with Enron. Enron's auditor was Arthur Andersen. You don't hear about Arthur Andersen anymore because that CPA firm was dissolved. They were found to be guilty and complicit in some of the scandal and fraud that was going on at Enron. And so the U.S. government decided in the Sarbanes-Oxley Act to introduce a new level of supervision, and that is in the Pcaob, to issue what they call inspection reports of engagements that auditors have been enlisted to give their opinion on when they go and monitor a client to ensure that they're in line with GAAP. So the Pcaob is just saying, hey, did you test these things correctly? Did you apply audit standards correctly? The Pcaob also is in charge of building auditing standards, and that is a huge role that they discharge. One other item I want to talk about is International Financial Reporting Standards. This is the foreign counterpart to US GAAP, and it began really in 2002 officially, when the IASB, or the International Accounting Standards Board, is the flag to the Financial Accounting Standards Board in the US, right? So what is IFRS? Basically, understand that there are different economic systems in foreign countries in the United States. Their accounting rules and regulations were distinct, but we used to have, China GAAP and Japan GAAP and German GAAP and UK GAAP, a lot of different GAAP systems. This was an attempt to harmonize how different countries report. Now, every country that's a part of the European Union must report under IFRS standards. That's part of being, within the European Union. Also, the U.S. government has allowed companies to register on U.S. markets, provided that they use IFRS. Before IFRS, everyone had to use U.S. GAAP to trade on the U.S. stock exchanges, but that's no longer the case. They did this really for two reasons. One, they wanted to make it easier for foreign companies to list on those exchanges so that, the U.S. could have more foreign influence or foreign investment opportunities in U.S. markets. They did it for a second reason, in that they also noticed a dramatic increase in the number of U.S. companies that began having multinational businesses. So companies that had businesses that opened up in Germany and France and Japan and China. Those companies then can use IFRS and still trade on U.S. markets if they choose. Right. What's the difference between U.S. GAAP and IFRS? Really, it's not a whole lot. There is something called the Convergence Project, and the Convergence Project was agreed by both the and the I. Essentially, they say we're gonna iron differences with new standards, or create additional differences. They're trying to converge. They're trying to meet in the middle, if you will, so that we don't have a whole two different, very distinct systems. They do differ in very key ways, and the differences are starting to smooth out, mostly due to the US GAAP becoming more like IFRS rather than IFRS becoming more like US GAAP. Of course, Americans have a lot of pride. They're not going to just say, screw it, we're going to all be under the purview of IFRS. They want to keep US GAAP. And to the credit of US pride, US GAAP is considered one of the most rules-based accounting systems in the world. It has been looked up to by other countries in terms of its rigorous requirements in reporting and disclosing information. But it is rules-based, which means that, there are certain built-in thresholds. If you're over 90%, then this is automatically put on the balance sheet. But if it's under 90%, then it doesn't need to be there. So that is as opposed to what IFRS has adopted, which is more of a principles-based accounting standard, where instead of having a 90% threshold, it leaves it up to the user to determine, well, should this be on the balance sheet or should it not? It gives a little more what we call professional judgment rather than a sort of check the box threshold in order to make that decision.